Okay, so we have talked so far, FASB accounting standard updates, narrow and broad, and we went through the discussion of revenue recognition under topic 606. And so we actually have a reporting cycle kind of under our belt right now. We may still have some that have yet to be issued. My best recommendation is be glad you just had peer review and work on it until the next 3 years, right? No, I'm just kidding about that. But just hopefully as this topic, as we get deeper into it, we'll get good guidance that's out there. I will tell you this, the guidance that's out on topic 606 is better than the guidance that's out on special purpose frameworks, right? Now, do you all do any non-GAAP based financial statements? Yeah, those special purpose frameworks, we used to call them OCBOA. And when it comes to professional standard guidance on theirs, where do you go? I mean, let's just say you're doing an income tax basis of accounting, right? And so, where do you go for guidance in preparing financial statements on the income tax basis of accounting? Oh, that was a question. Yeah, that was a question. I didn't know if y'all got that. Just what took a journey. Internal Revenue Code, and then we know how that works out for you. Because I don't think they've got guidance in there really on how to prepare financial statements under the tax basis of accounting, although that should be your authoritative source. Even better, where do you go for the modified cash basis of accounting? Yeah, crickets, man, right? There's no authoritative guidance, really, on the modified cash basis of accounting. We've got some good non-authoritative sources. The AICPA puts out a cash and tax basis, guide. Thomson Reuters puts out, tax and cash basis guide. I was one of the editors of that this year, so it's a pretty decent guide. But there's no good authoritative, do y'all have anybody who does a modified cash basis? We may have a handful that do the modified cash basis. And the whole question then comes, well, how many modifications can they make? Or which ones are logical? Or is this really just GAAP less a couple things? Which, if we were really to get down to it, yeah, they didn't want to consolidate VIEs before this came out, they just did that. Or they didn't want to record revenue in a way like this, and so it's every place GAAP except for. So we got to be real careful with those, first and foremost, because it's not good guidance. Secondly, that may lead your client to really, issue some statements that could mislead a user based on some of the other things that they have that they don't have to record under that basis. Yeah, have y'all ever used the FRF for SMEs? You might know what the FRF for SMEs is. Can anybody spell FRF for SMEs? The Financial Reporting Framework for Small to Medium-Sized Entities. It's a framework. The ICPA, put it out when they were talking big gap, little gap, and they didn't get their whole big gap, little gap like they wanted to, so they said, we'll show them, we'll put out a framework. Nobody uses it. But it's a pretty good framework, and it actually has guidance. And it's loosely based off of the accrual-based income tax method. And it's a pretty good framework. We just haven't been compelled to have any of our clients use it and so forth like that. So the one that has good guidance, nobody uses. The ones that don't have good guidance, we're like, I'm in. Tax basis of accounting. And so your tax basis, does it look different from your tax return? No, so you take, 100% of contributions or 50% of contributions on your financial statement. Keyman life insurance. You see what I mean? You'll get calls, hey, well, how come taxable income is different from net income on the income tax basis of accounting? Because I've seen firms who do that because they don't include the reconciling items or they don't show reconciliation. So even that, although GAAP, there's a lot of stuff to it, 17,000 plus pages, at least they got guidance. at least it's something we can kind of, put to use as far as guidance goes. When we're using special purpose frameworks, again, we got to make sure we're careful. And we do some financial statements that are other than GAAP basis. And so we just need to make sure we've got good guidance and we apply it in a way that the standard, if there were a standard, would require, right? Okay, so we're going to skim real quickly through, unless y'all want to really get into CECL. Do y'all deal with CECL? Credit losses, current expected credit loss model. This will really kind of dig in more to financial type institutions, really, maybe more than non-financial institutions. This is the second phase of the financial instruments project. If you remember the first phase really dealt with debt and equity securities, where they made some changes to equity securities, or they really let debt securities alone. Where now all equity securities are measured at fair value with realized and unrealized gains and losses going through net income instead of using other comprehensive income for your unrealized. So I like what they did there. They don't care what I think, but I like it, right? I think those were good changes. Didn't change a whole lot for debt securities. And then this is their second phase of their financial instrument project. Introduces this current expected credit loss model, which it's going to replace the incurred loss model. So it goes from what actually happened to let's estimate what's going to happen. And that's what this does, okay? Does converge with the IFRS. All three of these big three standards, when it's RevRec, financial instruments, and lease accounting, are all convergence projects with the International Financial Reporting Standards Board, okay? This one doesn't converge. Lease accounting doesn't fully converge. RevRec did for the most part. There were some areas where there was a little bit of divergence, but for the most part, they converged. But this applies to all entities that hold financial assets, net investment in leases that are not accounted for through fair value. This may affect trade receivables. So, it could be that you've got trade receivables that it's going to affect, loans, debt securities, and other financial assets. And so, what are the financial statement issues? Well, you got financial instruments, measured at amortized cost, that use an allowance account. And so your income statement presentation will have credit losses. And here's your CECL model. How are we going to determine what this expected loss is, right? Because, we have to forecast kind of like a weatherman. 50% chance that they're going to collect on these. Well, we don't have to be able to tell the future, right? But we'll use historical loss experience. Requires relevant information about past events. So hopefully you have good experience to go back and say, hey, over the years, we have really experienced actual losses that total to X% of these receivables, of these loans, or whatever they happen to be. You'll assess the current conditions. Right now, interest rates are low, so people are spending and people can borrow and that type of stuff. It's not in the economy, all depending on what day we're talking about, right? The economy's not in a depressed state. We went through some big swings this year. For the most part, I talked to Josh about y'all busy, right? Ripley Doorn is busy. BMSS is busy. We go through our monthly financial statements with our partners, and we're having one of our best years in a long time. Okay? And so we look at current conditions. You need to use reasonable and supportable forecasts. Make sure that you're considering all the things that could affect collectability. And then you estimate the losses for the expected life of the asset. But again, we're not required to be a forecaster. Not required to forecast economic conditions for the life of the asset. So how do we do it? You can do it as a pool. They have similar characteristics. Accounts receivable. You sell product. All your receivables are on the same terms. 210, net 30, whatever it happens to be. Okay? You can evaluate accounts receivable as a pool instead of each receivable. All right? Evaluate the individual asset when not part of a pool. Let's just say that you're dealing with multiple types of products, so you have receivables from multiple, business entities that are all up under the umbrella of. Then it might be that you would do it separately. For collateral dependent assets, you measure the estimate of the expected loss as the difference between the asset's amortized cost and the collateral's fair value. Now, this is where we get, again, disclosures, and if you're a financial institution, do y'all do any financial institutions, by the way? We do a few credit unions, and that's it. So we do some. I don't work on any of those. But when it comes to disclosures for financial institutions, those will be more robust, right? So they'll be extensive. Need to be sure to enable the user understand the inherent credit risk, how they monitor credit quality, the estimate of expected losses. Boy, estimates is going to be a big area of test work for us going forward, isn't it? There was new SAS issued on estimates this year. And you think about all the stuff we've talked about so far when we have disclosures of management's estimates of variable consideration, estimate of expected losses, the estimate of the collectability. There's just a lot of estimates inherent within these financial statements now. And we never really have had specific audit procedures around estimates, right? Until some was issued this year. But think about it even in a review, where you're offering a conclusion on limited assurance that there are no material modifications need to be made to these financial statements. And the financial statements include the notes. So when we're doing inquiry, we may have significant inquiry and significant analytics on things like accounting estimates going forward. Because each one of these that we talk about the significant estimates and management's determination of what this estimate is. There they go again. More robust discussion in the summary of significant accounting policies. Remember when we started the class earlier and I said, man, listen, the summary of significant accounting policies takes up the bulk of what our note disclosures are. It's no different. I mean, there's going to be a lot of information in there. There's some, again, transition resource groups and so forth like that. Those are some of the issues. Some transition relief and so forth. Okay, credit losses. Do y'all deal much with derivatives, hedging? Okay. Move on along through there. And let's get to, that's just changing from LIBOR to so forth. Let's talk about leases. Now, even though, hey, does anybody know what the effective date for leases is now for non-public business entities? 22 is correct. So we've got some time on this one. Have you all had any discussions with your clients yet regarding lease accounting under topic 842? Because we try to do this with RevRec, and we had some discussions, and they were like, yeah, okay, yeah, just whatever we need to do, we'll take care of that. We would talk to them about it. This one, we have already had some discussions with clients. We are starting to reach out to vendors. I think I told you earlier in the day, we've selected about 5 of our clients who do a significant amount of leasing and ask them to present us with some numbers of their leases, the terms and all this type stuff, specifically more of their operating type leases, because we have some that do a fair amount of that. And so what we plan on doing with that is kind of projecting what those balance sheets are going to look at, and then we're going to set up meetings with our clients and their lenders who require those financial statements and who have significant debt covenants within those, just to say, hey, by the way, we told you it's going to change, and this is kind of what it's going to look like. What do you think you're going to do with those ratios? What needs to be done right now? We're 2 years out. I understand. I get that. We've got a while. But if you've ever had to have a legal type document changed, it doesn't happen overnight, does it? You know, it doesn't happen overnight. And I don't want to get into the point in time where we're doing the audit, review, compilation, whatever it is, to where we're about to issue those financial statements and we're doing some analysis ourselves, or it's in an audit and we're trying to determine, are they in compliance? And those numbers flip like crazy and they're out, and then say, oh, hey, can we get a waiver? Because by that point in time, who knows? It may be too late. I don't know. But I think those are some important discussions that we need to have, even though we get an extra year. You know, for years we talked about rev rate, and finally got here and hope we got it right. We'll be in the same boat, I think, with Lease Accounting. Yes, sir.
When you're talking about ratios,
Mm-hmm.
I was doing some research on whether that lease liability is considered debt for debt service coverage ratio. And I found research that said it wasn't considered, because it would be current ratio issues.
Yeah.
For debt service coverage ratio, have you seen that?
I haven't. I'm thinking about debt to equity ratios, if they've got those type things too.
The coverage ratio, my understanding is, would be considered.
And I'm not sure if that's a lender or if it's, is that lender specific or is that across the board? Okay. I mean, that's good to know. And it may be that they, you know, the lenders back out certain things. They do anyway, right? And they will back out. And maybe they will modify the way that this is. Of course, those are non-GAAP measurements. And of course, we're not opining or concluding on non-GAAP measurements, but these are clients' financial statements. And if somebody else is using those to make a determination on whether, you know, something we presented as GAAP puts them out of that, we've got to consider. That's good to know, though.
Not that I think the bank is be able to figure that out.
Right.
Education, I guess.
It is education, and it's just learning. That's why we want to get on the front of it and say, hey, what would it? And that's why we want to meet with those lenders also that says, hey, by the way, what if it came out looking like this?
Because you got to disclose if they're in violation.
Absolutely do. And here's the deal. If they are in violation, that could be a classification thing too, because if it's callable and there's no waiver, that stuff goes from long-term to short-term. And that could be big implication. And so that's why, at least I think, this one's going to be more impactful than Rev Rec. Personally, because this will change numbers. It absolutely will change numbers. And so, you know, a little history about this one too. Again, this was one of those that went through 3 different exposures. When standard setters are issuing professional standards that are big changes, what they're required to do, whether it's the FASB, the Audit Standards Board, Accounting and Review Services Committee, the GASB, whomever, they're required to put that out for public comment, right? And this comment period is typically about 60 days, maybe 90 days, so that the public, you know, I asked earlier who here reads professional standards, and we had some people like ashamedly, you know, do this, and they pulled their whole mask up over their head so nobody would see them, and that said we read them. You know, anybody ever read an exposure draft? Yeah, good man, right? Yeah. And they're all thinking, loser, because they're all just looking and laughing at you. I'm sorry, man, I'm a loser too, I guess. Yeah, I know. But here's the deal. When we're dealing with something that's going to affect our clients and their practice, and audit standards or accounting that affect what we're going to do, I kind of want to know about it, right? And so that way we can put things in place. And listen, before I sat on a standard setting board, I would never comment. I would never comment on, to them. I tell my friends, that's a bunch of idiots. You can tell they don't do this in practice. Or they wouldn't write it this way. Anybody else ever thought that? Be truthful, folks. It's okay. You got a mask on, I don't know who you are. Right? And so, that does happen. But this one was exposed, 3 different exposure periods. Because they got significant comments that came back, and they had to make significant changes. They had over 760 comment letters on the lease accounting standard. Let's contrast that to SARS 21. We had about 60 comment letters that came back after we exposed that. That's why this thing went through 3 separate exposures. They would issue it, people would say, it sucks, and they would change it. They sent it back, sucks more. And so until they finally got back to the 3rd part, and they're like, we quit. was the comment at that point in time, And so, they were talking converge, converge. And then finally, the international standard setters had a lot to do with it, and the U.S. standard setters didn't necessarily like the way they were going, so they said, we're going to go ahead and issue. And so after 3 exposures, 700 plus comment letters, they issued this in 2016, okay? After about 3 years before that, we were really hearing the language said, hey, we're going to issue, by the time they issue. Then they'd have a blow up and a discussion, or they would have a changeover in the task force that was working on it. But they finally issued it, right? And it applies to all entities that enter into leases and subleases for a period of over 12 months, right? So when this was, when all the scope was out, whenever people were initially hearing this, and here's for all leases over 12 months, the initial thought process was what? Structure them all as 12 months or less. We don't have to apply. Topics 842. Actually, for those that are 12 months or less, you have to elect not to apply topic 842. You can, but it's an election you have to make. But for those greater than 12 months, everybody has to apply, except for intangibles, exploration of non-regenerative resources, biological assets, inventory, assets under construction. I always listen to, I've got a friend, her name's Melissa Galasso. She's got a firm, she just teaches. She does training all the time. She is great. She came and did our Yellow Book training. She does these type of, she's great. She's talking about, she's got a daughter who rides horses. And so, they've come to the process that, she does all these things, and horses are expensive to own, so they lease a horse. But, they don't have to capitalize that horse. It's kind of a biological asset, stuff like that. And so, we don't have to set up those type. We don't have to capitalize up. Y'all lease staff? Yeah, like I capitalize this staff A over here. They're already impaired. And so, you got issues like that. That was a joke, man. That's an after lunch joke that just flew over about everybody's head. But it wasn't funny anyway. So this is leasing. And it will capture every lease, and especially every lease of greater than 12 months, whether it's what we would call now an operating lease or a capital lease. It still retains the 2 options. We'll have what's called financing leases. That's what we think about now as capital lease, and operating leases that we think about now as an operating lease. Okay? Now, it's my understanding that the international standard setters just went to one model. I wish the U.S. standard setters would have gone to one model. I don't know why they kept the 2 model expense if you're going to capitalize them both. The recording of the asset and the lease liability will be the same, except one has a 2 lease expense of interest, interest and amortization or depreciation, and the other one just has lease expense. And I don't really understand, but anyway, that's how it is. So this was one of the first ASUs that was issued in regards to lease accounting. It talks about land easements and land easements only that were in place before Topic 842, weren't accounted for as leases under Topic 840, but just for these land easements, The entity can elect not to adopt the requirements of 842. And it's going to allow all contracts that meet that exception. Yeah, required disclosure and has the same effective date. That's land easements only. So, lease accounting now. Here's some of the changes. When it comes to the definition of a lease, the definition is different than what we have right now under current lease accounting. Okay? And so when we read, I'll read the definition for you and I'll kind of emphasize the words that change. But the first one that changed is that it's a contract. Current lease accounting does not call a lease a contract. Okay? This is a contract or part of a contract, conveys the right to control. So the term control is pretty much new under topic 842. The use of identified, so the whole identification, the identified property, plant, and equipment for a period of time in exchange for transaction. So it's now it's called a contract, and it talks about control, and it talks about an identified piece of equipment, property, plant, or equipment, whatever it happens to be. Okay? And so then we start thinking about, well, revenue is contract also, right? And so now with leases, that contract will be just similar to the other. Maybe written, maybe unwritten, whatever. Think about do y'all ever deal with related party month-to-month leases? Are those things written down? No, they're not. But are they a contract? Yeah, I think they are. What are y'all going to do with those? Disclose that they have them? You're going to capitalize them? Because they're month to month, right? What about where the standard says, hey, if the intent is, if it's reasonably possible, if the intent is they're going to renew, that should be a part of the lease term, right? And so, for me, I think we could get away with doing that also, of just saying it is. But I think we'll probably get some pushback for some folks who say, hey, you know what? They renew the thing every month. So, and they've only been doing that for the past 87 years. Well, I talked to my client. They're just not sure if they are or not. 87 years, Mike. Well, the building may fall down tomorrow, so they may not be able to. Some of the considerations we've been thinking about, at least with some of our clients, is maybe saying with some of these owners, hey, you may want to consider, like putting together a 5-year lease contract. Something similar to that, possibly, maybe, if these are some areas that we think about. But they certainly would fall up under the exception. We can't make them, make them have a formal contract that puts definite periods in and so forth like that. But I think those are some things we're going to have to consider with this, right? And so we got these contracts now. And then you see that second bullet point, separating components of a lease contract. Each underlying asset is considered to be a separate lease component, possibly. But let's talk about separating components of a lease contract. So one of the things that I started looking at whenever this came out was the fact that, okay, so my lumber mill client, the part of the byproducts from producing lumber are things like mulch and bark and chips and dust. Now they use the dust to fire their boiler kilns, where they're drying the wood and so forth like that, but they sell the others as byproducts. And so they had a contract with a trucking company. And that trucking company, I asked them, I said, hey, by the way, I know that y'all got a contract with them, that y'all pay them X number of dollars to haul this stuff off. They're like, yeah, we do. I said, do you mind if I see that contract? So I got a copy of the contract, and I started reading the contract, and the contract says, hey, this is Williams Brothers Trucking, blah, 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 blah. We're going to leave, 10 of our trailers on your place for you to use. We've got these trailer numbers so we can identify them. And, we'll leave them there, and you can put them up under your hoppers, and whenever the things are filled up, you can use your stuff to move it around and so forth like that, and put another one up on there. Then when they're ready to go, we'll haul them for X number of dollars per load. You know what's happened now under topic 842? for that 5-year trucking contract. Now those trailers are on, well, will be on the books of the lumber company. Because you got a contract that conveys the right to control the use of identified property. I know for years when I've gone and I've done the inventory work, I've seen those trailers, they've got numbers on them, I know which ones that, they can identify them that way. I'll see some that are filled up that are just sitting over here. I'll see others that are empty. And I've seen them move them around their own log yard, with whatever, vehicle they happen to do that with. And so now we've had a discussion of, oh, by the way, you have to set those up on your depreciation schedule. And those are going to be depreciated or amortized just like you own them. They're like, really? That's kind of the way I read it. They're like, man, this is just a trucking deal that we pay them X number of dollars for things that they haul. I say, yeah, but you're having the right to use these assets. And so, it's instances like that I hadn't really considered until I started looking kind of client by client at some of these significant, contracts that they may have. If nothing else, under Topic 842, I'll probably read more contracts. I told you I read professional standards. It's not that I just love it. I like other things too, much better than reading professional standards. But I think I'll be doing a lot of that because I think things like that will sneak up on me. I just think they will. I hate to use that term, sneak up on you. It reminds me of the time, like I was in Connecticut, teaching for the Connecticut Society. It was either last year or the year before, and there was this guy. He was just an interesting cat. He kind of set off to himself. He came in late. He just had on like a white undershirt and these khakis, that zip at the knee, and nothing wrong with those, and stuff. But he sat there, and at the break, I was walking out at the break, and he's like, hey, guy. I'm like, hey, man. He said, you like cars? I'm like, sure. What kind do you drive? So I said, well, I drive a Mustang. He said, got me a Mustang. You want to go see it? I'm like, no, got to go to the bathroom. Maybe when you get through, you can come see it. I'm like, I probably won't, but thanks for the invite. He said, I like cars too. He said, and I just couldn't get away from the dude. And so we went through this, and then after lunch, I kind of had a little holding. Well, he's sitting up at the table, kind of like looking at people. He's like, hey man, can I tell you a story? I'm like, man, I'm about to have you arrested because you're like creeping me out. But he said, so I've got these. He says, do you like the Tesla? I said, Tesla's a great car. Sure, I'll have one. I'll buy something else before that. But anyway, so he says, what I've done, he says, I've got about 40 high net worth clients by going and sitting. Do you know where their charging stations are at in Connecticut? I'm like, dude, I'm from Alabama. And all I know is we're a little better than Mississippi. And so, I don't know where the charging stations are here in Connecticut. He says, well, what I've done, he says, I've kind of staked some of these places out and did some guerrilla marketing. He said, I picked up 3 high net worth clients. I'm like, dude, I know you're blowing smoke right now. Because if you got any, he said, they got yachts, they got Tesla. He says, because people who own Teslas got some money. And so I'm like, so who in here has a Tesla? Hey, they're all in you, bro. I can hook you up with an account. And so he was telling me all this, and the people out there, the other people out in the room were like, dude, man, you need to run for your life right now. I'm like thinking, I'm finna force jump out of this place and I just ran. And I would probably run all the way back to Alabama. But what got me was, at the end of the day, he was waiting for me. I packed my stuff up. He says, hey, man, you come see my car? I'm like, listen, I got to go get in my Toyota Yaris that they gave me or whatever, as a rental car. He said, well, I got it right here. He said, just got a 4-banger on it. They'll sneak up on you. I'm like, okay. He turned on the car and couldn't even hear it. He's like, man, it's a hot rod. It's got these Recaro seats. Fortunately, they'll sneak up on you. He said that like 5 times. And so my 17-year-old kid, I told you about it, 91 dad, and he's kind of a little muscle. He likes, muscle cars. I told him about that. And, we'll pass. So he'd be like, yeah, sneak up on you, right? Sneak up. So I hate saying that it'll sneak up on you because it always takes me back to the creeper dude from Connecticut. I can't make these stories up. That is true as it comes. And in fact, I Lisa Bergen is the lady of the State Society office. I'm like, I need to find out this dude's name. If he's ever at another one of mine, I'm not doing it. You can find somebody else. I will refuse to do this type of stuff, or, you know, I will see him one day, and they'll be like, 15 bodies buried in this guy's backyard. Kind of snuck up on me. And that's what she's saying. She's been saying on Tuesday, all right? But with the, hey, listen, with these contracts that your clients have, you need to make sure you're reading them, right? Because they could have embedded leases within some of these contracts that would fall up under the capitalization rules under Topic 842. And so I told you we've got two different classifications. You know, under current lease accounting, we've got the capital lease and we have the operating lease. You know, your capital lease now, what are some of the qualifications we think with it? Why would it qualify as a capital lease? Maybe it's got a bargain purchase. Maybe you're using up more than 75% of the useful life. The asset, you're consuming more than 90% of its net book value, of its net present value, those type things. Those are the things we consider. It's the same, it's similar under Topic 842. Substantially all the risks and rewards are transferred to the lessee. So ownership transfers at the end. There's a purchase option. Now here's the key term. That's reasonably expected to be exercised. It's kind of like your dollar purchase, you know, bargain purchase option. The lease term is for a major portion of the asset's economic life. So you compare that to what we think about right now, 75%. If you still want to use the 75% rule, as I understand it, that's okay. The present value of the lease payments equals or exceeds the fair value of the asset. So that's the 90% rule that we use now. You can still use that percentage, is what I understand. And the asset is of such a specialized nature, no alternative uses of that asset after the lease term. So that would qualify as a finance lease. Again, this is what we typically think about as a capital lease. Not significantly different from the way we think about it now, is it? There are a few terms that are a little bit different, but not significantly different. Now, what is that lease term? Because, you know, we think about this lease term down here. What's the lease term? Well, that's a non-cancelable, I have to say that real slow. I can't say non-cancelable real fast. Well, I just said it right then. Most times I mess it up. Non-cancelable portion of the lease in the period covered by options that are reasonably expected to be exercised. Now, this is another area that I think we probably need to be out front with our clients about. That says, hey, you're entering into these leases. You typically renew these type leases. And, you know, if you've got some of these leases that have an exercise option period in there, my recommendation would be you decide sooner than later. Because let me tell you why. Because let's just say that we've got a 5-year lease that has an option to extend an additional 3 years, 5 years, whatever it happens to be. And at the onset of it, the client says, well, I'm not sure if I'm going to exercise that option or not. So we go through the calculations with them to determine what the asset is and what the lease liability is. And then 2 years into it, they say, oh, by the way, we're going to exercise that. We got to reassess that lease value. Then we have to go back and recalculate the value of that asset and that lease liability. And so, you know, for us, we don't mind. Hey, man, we do math, right? That's okay. It's in our wheelhouse. We can charge them for that. But if we want to save some money down the line, save a little expense for them, a little bit of a headache, if they can make a determination early, then we won't have to go back and reassess it, unless it's got impairment issues and that type of stuff. Okay? But that's what the lease term says. And then what are your lease payments? All right? Any fixed payments, less any incentives, we'll give you $500 cash back if you go ahead and sign this lease right now. We want to get you in this, you know, whatever it happens to be. Any variable payments, the exercise price of an option to purchase, if it's reasonably certain to be exercised. Any termination penalties, payments to owners of special purpose entities for structuring that lease, and any probable amounts under this guaranteed residual value. Which says, hey, at the end of the lease, we'll guarantee it'll be at least this much. So there could be some probable amounts owed up under that. And why is it important what lease payments are? Well, when we're trying to determine what the lease liability is, It is the present value of the unpaid lease payments. So all those things we just talked about, when we're calculating the lease liability, it's the present value of the unpaid lease payments. And then we think, what's the right of use asset? How do we value the right of use asset? Well, it's the initial lease liability, right? Any lease payments made before the commencement date, any direct costs, less any incentives received. So that's your right to use asset and your lease liability under your financing lease, okay? You'll measure the right to use asset and the lease liability similarly under the operating lease. So there's going to be changes there. Now, subsequent measurement, again, this is what we talked about on your financing leases. And how do we handle this from period to period? Well, as we are making payments, or our client is, we'll reduce the lease liability and record interest expense for each payment. And then you'll have a to lease expense. Very similar to what we do now in capital lease. Really not much different at all. Some of the terminology change. Maybe some of what would fall up under what you're leasing could change. But it'll be a to lease expense. And now we got operating leases on the lessee side of it. As they are making payments, they would reduce cash. They would have a single lease expense for the total payments of the lease term and reduce the lease liability using an effective interest rate method. And then whatever your residual entry is to reduce that right of use asset. And you've got a single line item for operating leases, which we have a single line item right now. So the biggest difference here is we got a balance sheet presentation for operating leases that we've never had before, okay? And so, just think about it. For us, we don't own our Huntsville office building. One of the developers owns it, and there's a bank in part of it. There's a couple of other people in it. And so now, going forward, after Topic 842, PMSS is going to capitalize on their book a right to use asset, Huntsville office, and a lease liability for the Huntsville office for an operating lease. How do you think, what was the rationale behind capitalizing operating leases in the first place for the standard setter? Anybody have a clue as to why they thought it would be just cool to capitalize every lease, especially operating leases where we typically don't use?
To get that off-balance sheet financing on the books.
That's what it was. The SEC, and not the SEC that we do the audit of, the Securities and Exchange Commission, kind of studied some of these large companies and found however many billions of dollars of what they call, debt, not on the books. My first comment probably would have been, well, is a lease actually debt? It's a commitment, and if you read the notes of the financial statements, what does it have in there? Lease commitments, right, for a minimum period of 5 years. So if there's concern there, okay, why? But again, that was the whole rationale. You've got debt, what they determined to be debt, that's off the balance sheet that they think should be recorded. And so that's how they really came out with this. And so now you'll capitalize every lease that has a period of more than 12 months. Okay?
Because even going back to the concept statements, though, they do deem a liability or a debt under the concept statements.
Yeah, I know. They do. I just don't know that I agree with that.
Yeah.
To me, it's more of a commitment than it is debt. I know you're thinking, wow, this is just strange terminology, but what if they could get, they can't necessarily get out of debt, but what if they could get out, what if there were a way to be released from some of these leases? Should that be debt or is that a commitment? And so, anyway, it doesn't matter what I say now, because this is the standard that we have, right? So what are some of the considerations we think about going forward? You know, think about all the things that your clients lease. You know, what are your consideration around things like postage meters? Materiality come into play? I think it does. For me, I'm thinking, hey, what about their capitalization threshold? Should their capitalization threshold come into play when it comes to leases also? If we've got, or should they reconsider for this? And I'm not sure that I've got a good answer for that. But man, if it's a postage meter where they pay, you know, $300 a year, I'm not sure that that's something that will be capitalized. But then you think about copy machines. You know, because we still have quite a few of those even in our office. You know, the school board, I do our local school system audit and so forth like that. They got a bunch of copiers because they got a bunch of schools and teachers make a lot of copies, administrators make a lot of copies, and all of those are on separate lease terms, and it's really strange the way to do it. And the band boosters have one, and the athletic club has one, and you know, this group has one, and that group has one. So some of the discussions we've been having with them is, hey, you might want to consider getting all of these copiers on the same lease terms. So at least then we could group it as one and do it as a pool, rather than having, you know, 87 different copier leases out there that we're trying to track and keep hold of. Because that would be a nightmare. That would almost be like your nano learning opportunities that you have under CPE right now, right? Where you can get 10 minute, you can get CPE in 10-minute segments, you know, and it's a reporting nightmare when you have to report those, whatever your reporting period is. Yeah, I listened to 362 10-minute segments. They were all awesome, but here's, you know, a spreadsheet for days, and you got to report it that way. I think that's some of the things that we'll run into with some of our clients going forward. You got multiple of these same type. Well, can we pool them? Are they on the same lease term? Because think about if they're on different lease terms. You can't pull them together. And so that's been some of the consideration for us going forward. From a presentation standpoint, on the lessee side. Now the leaseor side of it does not change significantly. Do y'all have clients who are leaseors who do leasing to others? We have a few, not many, but we have a few maybe. Didn't really change the accounting much on the lessor side of it, but presentation-wise, you'll show separate presentation of the right to use asset and lease liability from other assets and liabilities. Now, you will have the option to do that in the notes of the financial statements, or your clients will. If you just want to say capital assets / net, debt, short-term, debt, long-term, and then disclose them separately in the notes, you're going to have the ability to be able to do that. If not, on the face of the financial statements, you may say, purchase fixed assets, right to use asset operating, right to use asset finance, notes payable, lease liability financing, lease liability operating, short-term, long-term. You know, they'll have the option to be able, for presentation. On the statement of income, you'll have a one-line item lease for operating leases and separate presentation of interest and amortization for a finance lease. And then the statement of cash flows, you know, cash payments used to reduce the lease liability will be from financing activities. All other cash payments will be from operating activities. Disclosures, here we go again. Words and numbers about each lease. Assets and liabilities recognized. Future minimum lease payments, I don't know that they put how far out you are required to. I know currently we do 5 years, or you know, we may say 5 years and thereafter. But future minimum lease payments, the disclosure of any options, any guarantees expected to be paid, penalties, the lease term, significant judgments used, and of course the amounts recognized in the financial statement. So there again, our disclosure requirements will be going up. Our presentation issues will be different than what they are right now. Do you show your capital leases separately from your purchase fixed asset, or do your clients? Okay. But now we'll break those down between operating and financing. And, you know, with your debt, do you put your lease liability in just debt, long-term debt, short-term debt, that type of thing? Maybe we show them separately in the notes of the financial statements, those under capital leases, those notes payable to the bank for, you know, whatever, these others. So some may change, some may not. You know, the lessor accounting really doesn't change much. Again, you'll see the finance leases classified as either sales type or direct financing leases on the lessor side, where they'll de-recognize the underlying asset. And then this is how they recognize income for the direct financing. Of course, again, this is going to be under your financing lease. They'll de-recognize the underlying asset, and then recognize the loss, and of course any impairments. When it comes to the operating lease on the lessor side, they will set up a right to receive payment type account. They'll defer any initial direct costs, and they'll expense indirect costs over the same term, okay? And for presentation on the lessor side, they also show separate presentation for lease receivables. Just like now, they will classify as either current and or non-current. Separate presentation and disclosure of lease income. Okay, so what about things, you know, when you think of some of the things that may be a concern going forward, some of the things we think about are sale and leaseback transactions, leveraged lease arrangements, something up there. What about subleases? You know, what happens in a sublease? Right, you got a client who's stuck in a lease that they can't get out of, but they can find somebody to sublease it from them. Boy, when we're talking about recording a right to use asset and so forth like that, and then we're going from a lessee to a sublease, who holds the, you know, who records it, who's got the head lease, there's just a lot of complications that could come into play when it comes to those type things that we need to make sure that we consider. So when we get to the whole transition of it, on the lessee side, there's a modified retrospective approach, which says you'll take it to the beginning of the earliest period presented, or you can opt to elect it in the year that it's effective. Okay? So if you're showing comparative, and you just want to say 2022, we're going to take the modified, we're going to just include it in this year. Then that may be one of those where you're really not looking apples to apples. You're showing comparative years. Because I think it's going to change the way the balance sheet looks for everybody. And you may not be looking apples to apples. And so that may be a consideration going forward. Therefore, again, we will be one who will be showing single year presentation more than likely, unless we have to show comparative years when we use the modified retrospective method. And so for those leases that were previously recorded as an operating lease, then at transition, you'll set up the right to use asset and lease liability. And then those that are capital lease at transition will really just change terminology. They'll call it a right to use asset. No significant change there. Effect on this is change the name of the accounts and how they're presented. Measurement's going to be the same. Okay. There's some narrow scope improvements to lessors. We won't really be concerned about that. So that's leases. We've got until 2022 for our clients to have to put this into place. I think the sooner we talk to them about it, the better. To give them time to get modifications to any debt covenants, to do research just like the gentleman did over here that says, hey, into this ratio, this may not come into play. But to go ahead and have these discussions with lenders, with our clients, so that we can address these before it becomes too late. Because you don't want to get there, you don't want to get to where they're issuing financial statements that puts them out of compliance, when it's something we could have addressed well in advance. And I know if you're probably, I mean, we're all in the same boat. We're like, yeah, we've got a lot of time to be able to do that right now. We don't have anything else going on. Right? I'm busy with it. I understand this is one of those kind of value-add services that could probably help our clients out. Any questions on lease accounting? Good, because we got a while until we have to talk about it again. Right? How many people would like to see this pushed out to infinity and beyond? I said that, our firm, so anyway, our Huntsville office, for years it was another firm that got consolidated, that got purchased, that merged into BMSS. And so, man, when it comes to Halloween, I don't know if y'all dress up for Halloween or anything, y'all have any? Oh yeah. So like, this was my first year to be there during Halloween. And they're like, Mike, it's a big deal in our firm. I'm like, okay. Because I could go in our kitchen and I see pictures from prior years. It's the audit team versus the tax team versus GovCon versus cash. And as a group, they bring somebody else in to come judge the costume. Yeah, what's in the water down there, bro? I don't know. So this year, I mean, so anyway, we've got a lady who works for us. She's our consigliere, whatever. She does. So she's like, okay, this is when our annual Halloween contest is going to be. We've got a couple people come in and judge costumes. You need to make sure. Let me know, because we had Red Robin come in and cater the event. So we had food and. So guess what the audit and test side was? A Toy Story, right? I mean, infinity and beyond, right? So yeah, yours truly, dressed up as Woody. Thank goodness I didn't have to drive 20 miles to my office dressed up as Woody. Because sure enough, I would have gotten stopped. And of course, I'm sure it would have happened, because I probably would have been going a little faster than I should have. I used to say, sir, do you know what you're doing? I mean, you're my favorite deputy, or something like that. But we won this year. We actually won a couple of gift cards, so we've got, one day we're going to have, food brought in for staff from our gift cards. It's a big deal there, man. It never has been before. Now, I will tell you this before, when I did a small firm, and I was out doing the school board audit one time, I had to go to a couple of elementary schools during Halloween. And I had been doing the audit a number of years at that point in time, and so I knew the people in the admin office, and they said, hey, we're dressing up in such and such this year. So one year, I really kind of surprised. They didn't know who I was. I went to the front desk, and they're like, can I help you, sir? And I'm like, yeah, I'm the auditor. And they're like, no way. It was like a hippie or 60s or 70s and stuff. So, I mean, I had a big fro. And I had a big mustache like this, and like tie-dye shirt. I mean, it was just, nobody knew who I was. It was pretty fun. So y'all do that kind of stuff? Josh is going, no. Yeah. I know, my kids are old, man. We had dressed up for Halloween for years and stuff, but man, they kind of get into it there. That's okay, though, because listen, we got a good team. They're close. They get into things like this. COVID-19 has kind of stopped some of our get-togethers. As much, but after our 10-15 deadline, our employee benefit plan group, we went down and met with some of our Birmingham firm at Top Golf, and so we did some of that. They're going to come up to our place, and we're going to go to Stars and Strikes and go bowling and stuff. And so we've kind of missed doing that type of stuff, but it's all good and fun when you got to deal with these type of things, right? When you got to deal with issues with your clients that are big deals to them, that we've got to make sure that we're giving them good information. Okay, private company financial reporting. I have been told to fly through that. There is one, let's see. Well, no, I wasn't told to fly. I was told to hit these issues, right? On things such as, well, let me just get to the first one. What the PCC is they were formed to study gap and see what alternatives might be available to those non-public business entities, right? Since we don't have big gap, little gap, although we've been discussing it for years and years and years, and the outcry was we've got to have it, we don't have it, so the PCC was formed, and the first thing they did, the FASB did, was put what is a public business entity. If they are a public business entity, then they cannot elect any of these gap alternatives that the PCC has issued. So the PCC came out in 2014 with 02, 03, 07, and 18 that gave some exceptions to gap for non-public business entities. that simplify GAAP somewhat. And it helped out some of our clients, right? 2016-03 came out, and it said, oh, by the way, we're going to remove the effective dates of all those that they put out because there's been confusion. And it could be that some of these people who wanted to implement these didn't do it till later. And at that point in time, they had to document the preferability of why they're doing it now instead of when it was applicable. So we want to make it simple for everybody. So all this one says is, hey, these things are effective immediately upon issuance and indefinite. So we got, well, we're going to go into each one of these. When it comes to intangibles, we talked about what goodwill is. And so all this allows these non-public business entities to do is go ahead and amortize goodwill again for a period not to exceed 10 years. For these GAAP exceptions, do you all have some clients who took advantage of them? Did you all make any recommendations to your clients about whether you should or shouldn't? You know, we did. We didn't just blanket say, hey man, do it. Do it, that way we won't have to go through and impair. That way we won't have to go through, you can amortize, you can get, because for years they're like, what is this on my balance sheet? It's goodwill. And we explained to them what goodwill was, and they're like, so it's a plug balance. We're like, yeah, and it can't go anywhere. Well, I can impair it if it's impaired. They're like, really? What would that entail? Me doing a lot of testing and billing you a lot of money? No, it's not impaired. Everything's good. We can sell it. Who's looking to buy goodwill? Nobody. Okay, so it's on your books. Not much you can do with it. Okay? And so now we're able to do this. Well, you know, instead of blanket, just saying, hey, do this. It's good for you. It's on your books. You've been fussing about it for the longest. And then you write it off, and then they're like, how did I have this big loss? I thought I made more money than this. Well, it's an expense, right? Non-cash type thing, like depreciation and those type things. But it's not always the best idea to tell them, hey, you need to go ahead and do this. What if in 5 years they see themselves as being sold to a public company? Then they got to unwind all this because public companies can't do this. And if they get bought up by a public company, then you're going to have some unwinding. Of course, you're thinking fees. I can charge them because we're going to have to do this stuff. Think about the best interest rate client, right? So intangibles, I mean goodwill. I think this was a good one. Allows them to get rid of that goodwill that's on their book and one of those assets that sat there that we just never could do anything for because it never was really impaired. It also says how you'll only do the impairment test when a triggering event happens. It's a one-step test, and it's applicable right now and forever. That's a peer-to-peer. Interest rate swaps. This was one of those where you are swapping a variable rate for a fixed rate note, or your client is, when that would typically be, you know, some hedge accounting where they had documentation requirements where they got a documented contemporaneous with when it's going on. You've got all these other things that go on with it that a lot of times we wouldn't find out about until the end of the year when they bring us their information. They say, oh, by the way, we swapped this note for this. Yeah, has that ever happened? You find out after the fact, and you say, well, here's the deal, and you go through the whole interest rate swap. Well, this makes it into a simplified hedge, which makes it easier to account for. You measure things at settlement value, not fair value. You're not required to test the hedge effectiveness. And it has some disclosures. You had some different qualifying criteria. And again, it made it simpler on them when they weren't trying to complicate things in the first place. They were just trying to work on budgeting and know, hey, I've got a fixed rate now and I know my cash outflow is going to be. I don't have to worry about all this type of stuff. What was that? Okay. VIEs, when it comes to common control leasing arrangements, again, this is another one that they put out. Now, this one affected some of our clients. We would do some physicians, some offices of physicians that had a medical practice. They would run that medical practice. The physicians also own the building and the medical equipment and in a separate entity, and they would just lease to it. They would lease to the practice. That's all they handled, right? And so we'd have to consider them for consolidation as a VIE. And so, you know, this is an alternative accounting policy election. They said, hey, if they're under common control, the things that go between the two parties are a leasing arrangement. That's substantially all the activity, and there's no personal guarantees for more than the net book value of that property and so forth like that. If that's the case, then hey, we don't have to consolidate them as a VIE. Now, you'll have certain disclosures you're required to make, okay? And so they don't have to consolidate those qualifying VIEs. And then you're accounting for identified intangible assets. This also says, hey, if your client elected to amortize goodwill and they have these separately identifiable intangibles, you know, non-compete and so forth like that, that they can subsume those into goodwill and amortize those again, okay? But if they're going to do that, they have to make the election to amortize goodwill, okay? And so that's what that one is. This one is relatively new, and it allows private companies the alternative not to consolidate any VIE, okay? So it's not just common leasing arrangements. This is any VIE for a non-public business entity that they can make the election not to consolidate. You're thinking, that's glorious. There's a lot of stuff we won't have to do. Well, you've got a lot of disclosures that you wouldn't normally have in the whole VIE type thing, which means you've got separate enhances disclosure requirements. And here's what some of those are, I believe. Yeah, so you'll have separate disclosures. That, remember, these disclosures will be separate from all your other disclosures. That you can't bury them deep within another disclosure and get away with it. They'll be separate. You'll have other notes that will reference this. But the nature and the risk of the association, what's the impact of the involvement on the financial statements, a maximum exposure to loss, carrying amounts of assets and liabilities. And again, they can't be included with other disclosures, and you'll cross-reference them. So you may not have balance sheet presentation, income statement presentation, but you'll still have disclosure. But you may have some clients who say, hey, listen, I just want financial statements of my company right here, of our operations right here, not these other type things. And so for them, it may be more useful. Now again, understand this, if it's going to third parties and you want to make sure that your client understands these third parties need to know, and it may be better if it's on the balance sheet, then maybe so. Because, you know, more than likely, and this is just a guesstimate on my part, I would tend to think that more third parties look at the face of the financial statements more than they look at the notes. I'm not saying they understand either one of them very well, but that's just what I get from them so far that I've seen and had discussions with. So this may work well, it may not work well, but it's an option now, okay? Let's see. This is some of the other things PCC's working on, share-based payments they've been working on for a while. How many companies are you aware of that have adopted any of the PCC alternatives? At least for our clients, there have been a number who elect to amortize goodwill again. There have been a few that have done the leasing VIEs where they don't consolidate that anymore. We may have had a couple or so that had a plain vanilla interest rate swap. Those that consolidate VIEs, we have not had any that have elected the alternative as of yet. Okay? Any questions, comments on PCC activity? Who they are, what they do? Everybody can spell PCC right. Good? Okay. FASB exposure drafts. This is the one that we drive through, right? Because, you know, I got an email, I noticed an email at lunch, you know, FASB, blah, 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 pushing the effective date out of some insurance type things. And so they're doing a lot of pushing things out where initially, you know, they're thinking about, hey man, we're working on disclosure. Isn't it great they're working on disclosure projects?